India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. It's a Friday morning, and after yesterday's bashing, I think one only hopes that it's a quieter day, which just kind of passes through, and we come back, looking fresh and in a new way as the next week starts. So that's the hope here. Big cut yesterday. GIFT Nifty indicating about a 50-odd point lower start. I'm Prashant with me, my colleague Surabhi, and Reema is with us today. Guys, good morning.
Hi, good morning.
Good morning.
Guys, by the way, do you know what is the Navratri color today? It's green.
Well done.
I'm wondering, I have little bits of it here and there, but I'm wondering if the markets will decide to say, okay, it's green, it's Navratri, let's go with green. Enough of red from yesterday.
Where is red?
Oh, let's not even go there. I think we've had it already.
Oh. But today's important session because it comes on the back of a tough week when we were inundated with so much news flow. The China rally, SEBI, the Middle East attack, the rise in crude prices, and next week we've got earnings and RBI policy. So we just sandwiched. It's an important session in that sense.
Oh, no, absolutely, and the indication is that looking at Dabur and others, maybe earnings are also looking not exactly very excitable.
Yeah.
At least the previews put that message out. But we'll talk more about that as earnings start to come through. And let's sort of tell you what's happened. I mean, because the cut yesterday was large, 2% plus on the Nifty, the Bank Nifty, etc. I thought, why not take a look at how much markets have come off from the highs. The Nifty is down about 3.8%. The Bank Nifty is down almost 5% from the highs. The mid-cap, small-cap indices highs were different. Actually, the highs for each of these indices is on a different date. 26 for Nifty, 27 for the Nifty Bank. Mid-cap and small-cap highs were made even earlier. So 3% on the mid-cap index, small-cap index down about 3.5%. So this is what we've lost for each of these indices, respectively, from the highs for each of them. Now, let's take it to what you need to know in terms of just the cues over the last 24 hours or so. So oil's up another 5%, and we are now knocking at nearly $78 per barrel. And from, so oil was about 71 and something change before the attacks, the Iranian attacks over Israel, and we're at 78. That's a large step move that we've seen in oil in just 2 or 3 sessions. The worry, of course, still remains potential strikes on Iran's oil facilities. And, we were talking about this yesterday, that previous episodes have all seemed a little bit coordinated. This does not seem coordinated, and hence the risk of spiraling out of control. And of course, we'll talk more about this in a bit from now. And that's the worry. Now, equities, nothing very much. They mostly sat on their hands. S&P was flat. NASDAQ was flat. The data point was good. The ISM services data for the US came in at 50, almost 55. Expectation was about 52. It's the highest since February of 2023. Now, services is the larger part of the US economy, and it's also the more sticky part of the US economy. Remember, employment component did dip, but markets kind of paid attention to the rest of it, which was strong. Yields, as a consequence, rallied sharply, 7 basis points to about 3.85% on the 10-year. Dollar was also, as a result of the rally in yields, a global outperformer. We are back at just at about 102 levels on the dollar index. And of course, later today, we'll get the US jobs data for the month of September. And actually, it's a wide range of expectations, starting from 70,000 to 220,000. The median is about 143. And this is only important because, we got the first Fed cut of 50 basis points. Was that the deepest and the largest? And now we'll see 25. Or is there room for, what's the bar for another 50? I mean, I think that's essentially what markets would like to see. If it is closer to 70, which is the lower end, well, markets will quickly price in 50 for the next as well. If it is in line with expectations, as we've heard from various Fed officials, it's going to be 25 over the next many meetings. So let's circle back the levels here in terms of what you need to sort of put the back of your minds. We put out 2 levels yesterday, the 20 and the 40-day exponential moving average. The 20 got broken convincingly, and we left at the second support level, which is the 40-day exponential moving average, which is 25,222. We left 25 points above that level as of yesterday. So that is the first marker. I mean, it'll be great if you just kind of close around these levels, and we'll kick off and pick up next week on Monday. The hourly RSI, the relative strength index, is extremely oversold, and perhaps that means that in a day, 2 days, we perhaps should see a bit of a bounce. But if you get that bounce, this gap area, which is formed from the fall, which we saw yesterday, as compared to Tuesday's close, because Wednesday was a holiday, is the gap on your screen. 25,640 to 25,740. That's the gap area. That's the resistance zone for the Nifty to take out if you're able to, if you have to build and look ahead. Nifty Bank similarly has trendline support. That, by the way, broke the 20-day and the 40-day exponential. The trendline support is at about 51,585. We left off at 51,845, so less than 1% away. The 20 weekly moving average, by the way, below the trendline support is 51,344. These are all very near-term supports, well within just 1% from where we left off yesterday. So keep these in mind. And similarly, like the Nifty, for the Bank Nifty, the resistance zone is that gap area. And for the Nifty Bank, it is 52,582 to 52,817 up on your screen. I mean, lots of variables out there, which I think markets will watch. If yesterday, for example, we saw a very large FII sell number, and at the very near term, if it is to do with, China and outflows out of other markets to fund the China exposure, when China comes back next week, it'll be interesting to see whether they actually walk the talk, because it's all talk right now on the fiscal front, etc. Remember, Hang Seng, after 13 up days yesterday, was down 1.5%, and that's a China proxy. So we'll see. Lots of moving parts. GIFT Nifty is indicating about a 50-point lower start. Survi.
Okay, well, if we talk about markets in Asia, just like Wall Street, they're kind of biding time till there's more clarity on what's happening with both West Asia, the whole conflict, as well as, of course, the non-farm payrolls report. Let's just put up the Asian markets as we kick off. There's a little bit of gain on the Nikkei for the time being, and Hong Kong, let's see what Hong Kong is doing. It's actually managing about a 1% move up, so it's not too bad after yesterday's cool-off. Taiwan somewhere in the middle. The market that's declining is actually Australia, which is down about 1%. So mixed cues across Asia coming through. Now, on this flare-up in oil, why did oil suddenly rally 5% overnight? Because, well, the US president moved the market. Reporters went up to him and asked about a potential Israeli strike on Iranian oil facilities. And I want to pull up the quote, so sort of we quote him verbatim. He says, and I quote, "We are discussing that. I think that would be a little anyway." So slightly cryptic, but he said that it was enough for the market to get very nervous about the possibility of the US backing any Israeli move against even oil infrastructure in Iran. So let's see how this plays out. Not sure if it was entirely intentional or inadvertent. Whatever it is, it moved the oil market in a big way, with Brent now closer to 78 than 70. Let's talk about just the non-farm payrolls number that we're going with. I mean, the mean expectation, like Prashant said, is around 150,000. The unemployment rate expectation is 4.2%. This would be a slight improvement from the previous month if we get numbers around this zone. Let's talk about the money moves, and that's what it's been all about, right? Aside of what's happening in West Asia, it's all about whether this is a bit of a sell India, buy China trade going on. And if money flow is anything to go by, you can't ignore the numbers, because yesterday in the cash market, we had selling worth over 15,000 crores from the domestic institutions. And kudos to the domestic institutions. They absorbed at least 12,000 crores of it. But even then, the market had to deal with what it did. If you put the last 3 days together, since the China stimulus really came through, the numbers are massive. 10,000 crores on the 30th of September. That's Monday. Then Tuesday was about 5,579. Wednesday, we had a holiday. Yesterday's number was this massive 15,000. So all put together, $3 billion of selling is what the market has had to deal with in the last couple of trading sessions. So let's see if there's any sort of relief from that, or how long does this tactical trade continue? And that's exactly what we'll ask a lot of our guests today on the show. Okay, let's talk about some of the other cues. The exchanges have spoken, at least one of them. That's the BSE. It is going to be discontinuing the sensex 50 from the 14th of November and the BankX from the 18th of November. So those contracts go away. The sensex 30 will, in all probability, be the one that they decide to continue. What will the NSE do? That guessing game is still very much on. We don't have the answers to that. Now, we'll talk about a lot of the business updates that are flowing in. Yesterday, Dabur was a big move in the market thanks to what they're indicating for Q2. Today, by the way, Avenue Supermart is not that bad. I mean, not that they're an exact proxy to each other, But if you talk about consumer demand, avenues numbers were fine. Let's look at a lot of the banks and the NBFCs. Just a quick sneak peek. Bank of Baroda's update is telling us that struggle is continuing. Look at the gap between the credit growth and the deposit growth. There is a gap. It's a big one at that. This is year on year that we're talking about. M&M Finance disbursements are actually down 1%. There's a small deterioration in asset quality. So we'll watch out for this stock. More commentary around this coming up. Bajaj Finance, the big headline number is still around the 30% mark. So the market will probably have a sigh of relief on that, 29% on assets under management. And finally, I'll watch out for the two-wheeler stocks, particularly the likes of even Bajaj and Ola Electric, because guess what? The festive season is on and big discounts are kicking in. Ola announced the Boss sale, the biggest Ola season sale, and discounts are going all the way up to 40,000 rupees on these EV two-wheelers. So is it just festive cheer? Or is it a sign of the major competitive intensity in the EV two-wheeler landscape? So I think some of the two-wheeler stocks will be interesting to watch. So plenty to keep us busy today, Rima.
Oh, indeed. And crude is the big story. And I was just reading that what if Iran's, facilities are attacked? What is at risk? We're talking about 4% of the world's supply. So every day, Iran produces about 3.3 million barrels per day. So that's the amount which is at risk. But oil analysts are also quick to point out that OPEC has spare capacity. So OPEC today is producing 27 million barrels per day versus their theoretical capacity of 33 million barrels per day. So, that's the numbers when it comes to Iran and the impact on crude prices. The question is, does it engulf even the other areas like Saudi Arabia, etc., or is it going to be restricted to, Iran and Israel, etc.? But that's, another story. But for our markets, I think the big question is that from the highs, we've not lost too much, just about 1,000 points from the 27 September peak. Week to date, benchmark indices are down 3.5%, going up to 4% for some of them. So will we have a bounce from oversold regions, or will the sell-off and the bloodbath continue? But let's get to some equity calls then. We've got Rhythm Desai of Morgan Stanley, who says the medium to long-term bull market is intact, but in the short term, the market has to digest rising issuances, policy shifts in the US and China, India's fiscal consolidation, state elections, and the frothiness in small and mid-cap. He thinks banks are the best way to play the next leg. He says they're overweight on financials, technology, consumer discretionary, and industrials, and underweight the other sectors.
Okay, well, those are some views coming in. Let's get some more, right? And flows is the big talking point. So let's get Cameron Brandt in. He's Director of Research at EPFR Global. Cameron, good to have you with us here. Thank you very much. Lots of talk, discussion, chat about, of course, the rally in China is so big in such a short time span. It's a literal shock. So there's a lot of FOMO, I guess, for people who want to chase that higher. And has that led to some serious selling just for 2 or 3 days, but large numbers in markets like India? Can you tell us anything if you've seen that in the flows?
I've certainly seen the flows shift to China at a spectacular level. Flows into both domestic and foreign domiciled China equity funds have soared over the past 2 weeks. And it really has, especially this past week in flow terms, been the only show in town. That said, even though flows into dedicated India funds this week were less than 1% of the flows we saw into dedicated China funds, they were still positive, which I would take from your perspective as a very good sign. Dedicated India funds have seen relentless inflows for well over a year. A lot of investors have built up a lot of exposure to a market that has risen sharply, but the money is still coming even when a very alluring alternative is on offer.
Cameron, hi, great to have you on the show. So what is the sense you're getting? I think the question that a lot of people in India are asking is how long will this continue? It's hard to guess, but this whole sell India, buy China tactically, or even send new money only to China and maybe not to other emerging markets like India. Do you see this trend lasting?
Well, I certainly see appetite for China going for a while. Chinese policymakers have made it very clear that they are paying attention to their equity market, and they want to see it on the rise. when Chinese policymakers say that at that level, it's likely to continue for a while. But as I just mentioned, even though flows to India funds have definitely waned, they haven't gone negative, and I think India remains in quite a healthy position. It looks to me, at least from this week, that investors were pulling money out of liquidity funds in Europe to fuel this rotation. And while that, money that might have flowed into India earlier this year clearly took a dog leg, it isn't as much of a straightforward India-China rotation as it might at first appear.
Cameron, is it possible to put some numbers when you say that India dedicated funds, money into the India dedicated funds has waned? What are the numbers that we're looking at, say, for the week gone by versus the prior weeks? And even for China, when it's gone up, what's the extent of the inflows?
So this week, the dedicated China funds we look at took in over $13 billion. A net 107 million flowed into dedicated India funds. But it was, I think, the 70th or 75th consecutive inflow into those dedicated India funds.
So just to get the numbers right, China saw $13 billion of inflows in the week gone by in the China dedicated fund, and India saw 106 million, which marks the 70th or 75th consecutive week of inflows. So there's still a surplus. So
it's still a surplus. It's definitely well below the average you were getting even a few months ago. For much of the second half of last year into this year, I would say the weekly average for dedicated India funds was around $400 to $500 million.
Cameron, so these dedicated funds, country-specific funds, are still very small as a source of money into India. I mean, the last number that I looked at, it's largely emerging market funds, which are the route through which most foreign money comes into India. So could you tell us what is what's the number, latest number, compared to, say, the average? How much of EM funds taken in?
If you're talking about the diversified global emerging markets funds, they took in about 700 million this week, which is not a particularly eye-catching number, but it's definitely up on the trend towards outflows that we saw for much of the first half of the year. And within those GEM funds, India's allocation, while still not as high as China's, is at a record high. So when they do get money, they're shipping a solid amount of it onto India.
Okay, the money that's flowing into China, Cameron, this $13 billion that's floated in just the last week, is it flowing at the expense of any other market? Just to get a sense of how money is moving, or would it be sort of perhaps fresh money being put to work? Is it coming at the expense of the US or any other market?
Yeah. Well, I think if there's a market it's coming at the expense of, it's Europe. But at least this week, it's more either money being put to work or domestic money, Chinese domestic investors rotating out of other vehicles within their country and moving back to equities. So, if it continues to run, and I think it will run a bit longer, there probably will be some, selling of other markets to fund this trade. But at the moment, there's been enough in liquidity vehicles and enough coming into the market generally, I think, to mute the impact on markets outside of China.
Cameron, great conversation. Good to get those numbers in. Thank you very much for joining in. Enjoy your weekend. We have lots of stock-specific action to track today, and we'll get to it in just a bit in our special Top 10 segment. We're looking at Bajaj Housing Finance, Bank of Baroda, CESC, EPAC Durable, Ola Electric. These stocks could open up in the green, or at least the news flow is positive, while Bajaj Finance, Avenue Supermart, M&M Finance, Sundaram Clayton are stocks on our radar that are likely to open in the red, while crude users may also be negatively impacted.
Okay, well, let's tell you what's lined up here in terms of corporate interactions which are coming up. So we'll at 8:35 be speaking with Siddharth Kemkar, Motilal Oswal Financial Services. At 9, we have Abneesh Roy of Nuvama Institutional Equities to discuss the FMCG sector after, of course, the Dabur shocker. Samir Arora of Helios will be with us, the market master, at 9:20. 9:30, we'll be speaking with Alexander Redmond, Chief Equity Strategist of CLSA, which is, of course, talk about this India-China dynamic. Ramesh Swaminathan of Lupin will be with us at 9:40. Lots to talk about there. That's a big one. And Nilesh Gupta of Vijay Sales and Anand Agarwal of V-Mart will talk to us as we sort of kick off the festive season with Navratris. So that's lined up here. And of course, my colleague Latha will be speaking at 10:15. We'll be discussing the RBI action on the 9th of October with a whole host of experts. So that's coming up as well. So lots here. Stay with us.
Welcome back. Lots and lots of stocks in focus this Friday morning. So let's straight away get to it. Our team is standing by with the CNBC TV18 list of top stocks to watch. Lots of business updates have been flowing through. So in fact, let's kick it off with exactly that. Abhishek is joining in to tell us more about names like, I think, Bank of Baroda, Bajaj Finance and many others. Abhishek, good morning.
Good morning. So to begin with, Bajaj Finance, the new loans are up 13.6% YOY and they have declined by more than 11% quarter on quarter. Now, quarter on quarter, it's seasonal in nature for them, with respect to new loans declining. Our customer base has grown by 20.3% YOY and 4.5% quarter on quarter. Now, the benchmark that they have set with respect to AUM growth, this 28.8% YOY looks to be the weakest growth in last 6 quarters, and 5.5% sequential growth looks to be the weakest in last 9 quarters. Deposits are up 20.5% YOY and 5.3% quarter on quarter. The cross-sell rate, now that's the lowest that you are seeing in Q2 of a fiscal X of the COVID time. So the cross-sell rate has declined to 6.2% versus 6.5% YOY and about 7.4% sequentially. With respect to Bajaj Housing Finance, they have given only 2 numbers. So loan assets is up 26.6% YOY and their AUM is up 26.3% YOY and about 5.5% sequentially. So the AUM growth remains strong for Bajaj Housing Finance. Back to you.
Thank you very much for that. Nomura says numbers are broadly in line. They will be watching the Q2 credit costs because, as Jeffries points out, the credit costs have risen for the last 3 quarters. So commentary on credit costs will be key for H2 and FY26. But Mangalam is now joining in to tell us about what Avenue Supermart did in the quarter gone by.
Well, it's a weak update coming in from DMart as well. Why do I say that? Because the revenue growth for the company on a standalone basis has been 14% in the second quarter. It's lower than the 18% that they reported in the first quarter. And more importantly, if you look at the 3-year CAGR, it's around 16.5% as well. So it's lower than that as well. Add to that, year-on-year store additions are 12.2%, which means that for a 14% revenue growth after a 12.2% store addition, it is weak same-store sales growth as well. For the quarter, they've added 6 stores. For the first half, that makes it 12 store additions. They usually guide for around 40 to 50 stores per year. That puts the onus on the second half for store additions. Currently, it's around 377 right now. The key to track would be how gross margins perform and how their quick commerce arm of DMart Ready performs as well. So I sense the stock would see a fair amount of selling today.
All right, Mangalam, thank you very much for that. Well, let's talk about Bank of Baroda and Mahindra & Mahindra Finances next. Abhishek is here with those. Abhishek, morning.
Morning, Prashant. To talk of Bank of Baroda, after the weak Q1 FY25 that we saw, they have bounced back strongly in Q2 FY25 with respect to their business momentum. Deposits are up 9% YOY and 4.3% sequentially. Domestic deposits are up 7% YOY but 4.1% sequentially. Advances growth is at 11.5% YOY but 6.7% quarter on quarter. So quarter on quarter, the 6.7% growth rate is one of the best that you are seeing in last 23 quarters for them. domestic advances are 12.5% YOY and 6.5% sequentially. In this, the domestic retail loans that have grown by almost 20% YOY and about 4.5% sequentially. Now, M&M Finance, the disbursements are weak. They are down 1% YOY, but up about 3.3% quarter on quarter. The total assets are up 20.3% YOY and about 6% sequentially. The collection efficiency has remained stagnant at about 96%. The gross NPA ratio has inched up to 3.8% versus 3.56% in the previous quarter, and they have inched up their liquidity in the balance sheet, which is now at 8,500 crore, up about 6.5% on a sequential basis. Back to you.
Okay, all right, got it. Thanks very much, Abhishek, for that. Let's move on to Vivek. He's, I think, tracking some developments with respect to renewable energy at CESC. And there is some news on Sundaram Clayton as well. Morning, Vivek. Tell us more.
Good morning. Absolutely right. So CSC is the first stock on the radar. So the company's subsidiary has gone ahead and signed a binding term sheet to acquire a renewable energy company called Bojraj Renewable Energy. The acquisition value is at close to 108 crore, and the deal is expected to be completed in 9 months. So what is Bojraj Energy? It was incorporated in 2024 to develop renewable energy assets. And what are the assets that they have? Basically, the company has land in place, and also they have term sheets in place to go ahead and develop 150 megawatt of solar power projects as well as 300 megawatt of wind projects. So positive there as far as CSC is concerned. Now, talking about Sundaram Clayton, again, a fundraiser over here. The company has launched a QIP to raise funds up to 400 crores. The indicative issue price for this particular fundraise is at 2,205 rupees a share, which implies a little over 6% discount to yesterday's close. Dilution at this particular rate is close to 9% of the total equity share capital. Why is the company raising funds? The company says they intend to go ahead and repay debt as well as for general corporate purposes.
Thank you very much for that. It's over to Vinny now for the latest on EPAC Durable and Ola Electric.
Good morning. So yes, keeping an eye out on EPAC Durable because they've entered into an exciting tie-up for manufacturing for Panasonic Life Solutions. They will be manufacturing PCBA controllers as an EMS provider as well as high-tech critical components from room air conditioners. Normally, they used to be manufacturing this PCBA controllers only for their captive use. So now this is a good entry and foray that marks for the company as an EMS provider as well as an opportunity that opens up for the company in terms of growth avenues and market leadership is what something that they could be watching out for, especially manufacturing for Panasonic. So expecting a green for EPAC Durables. Even Ola Electric, we're expecting a bit of a positive up move there. We've spoken about those two-wheeler discounts coming in during festive season. Now Ola announced and launched its Boss discounting. That's the biggest Ola season sale. This is a campaign for festive season, and the company has announced the entry into S1 portfolio for as low as 49,999 rupees. There are a lot of other festive benefits that they will be giving in as well. So keeping an eye out on Ola Electric.
All right, Vinny, thank you very much for that. So that's discounting, which will be in focus as well. Well, let's talk about oil prices, and Manisha is here with what's latest. Manisha, good morning.
Morning, and thank you for that, Prashant. Well, 5% of gains in the crude prices overnight, and we are trading at a one-month high. With that, this is the highest weekly gain that you've seen in perhaps 18 months coming for the crude oil prices. You know, it was a decline of 9% for the month of September, but in the month of October, the crude oil prices have gained up by 9% exact. And with the kind of news that you're getting in from Middle East, perhaps further gains are not ruled out before you see the end of this week. In other commodities, well, because of the dollar index surging to a 6-week high, the service sector data came in better from US. So did the labor numbers as well. That has weighed on in case of metals there. So copper prices fell 2% overnight. Aluminum has come off its 4-month highs. There is some pressure that we've seen come in for gold as well. That one has been trading off its highs for all of this week as well. We haven't seen a new all-time high in gold in this week. So that really has been a difference that we've seen in all of last quarter as well. The markets will watch out for the US non-farm payroll data. That will set the course for further move in many of these commodities.
Okay, all right, absolutely. Commodities on the radar, Manisha. Thank you very much for that. With that, let's quickly recap our list of stocks to watch today. The ones that have positive news flow around them include Bajaj Housing Finance, Bank of Baroda, CESC, EPAC Durable, and Ola Electric. While stocks with negative news flow are Bajaj Finance, Avenue Supermarts, M&M Finance, and Sundaram Clayton. Crude users may be negatively impacted, of course, considering the 5% surge that we saw overnight in prices. We'll take a quick break on that note. Coming up on the other side, we connect with Siddharth Khemka of Motilal Oswal Financial Services for some fundamental stock analysis.
Good morning. You're watching Bazaar Morning Call. We're in conversation now with Siddharth Khemka, Head of Research at BND at Motilal Oswal Financial Services. Siddharth, thank you very much for joining in. Wanted to get your thoughts in on what Dabur had to say. Dabur is talking about a revenue decline in its quarterly update for the first time in 4 years. And the street is clearly worried that it may not be limited to just Dabur. So in your channel checks going into the Q2 earnings season, what have you picked up in terms of consumer demand?
Yeah, hi, good morning. So I think, yes, it's definitely a cause of concern, especially if you look at on the urban side, what is happening. So consumer staples demand, our channel check suggests that demand has been relatively stable in Q2 on a Q-on-Q basis, with the rural markets outperforming the urban areas for the third consecutive quarter. However, we have seen that some of the issues, for example, heavy rains and floods in certain regions have disrupted the supply chain and also affected the out-of-home consumption and hence the overall consumer offtake. In terms of, if you look at the raw material prices, that has kind of remained a little bit on the softer side, and hence there is expectation of some gross margin expansion in Q2. And hence, some of the other segments, apart from, say, in the overall consumer staples, we believe things could see a little better. And hence, while Dabur has definitely kind of given an outlook of a weak quarter for the year, we believe some of the other names, for example, HUL, Britannia, Marico, their numbers could be slightly better than Dabur. And especially if you look at on the non-agri commodities such as crudes and its derivatives, that have kind of remained soft, and that should benefit companies in the space like soaps, detergents, paints, adhesives. So it's a kind of a mixed bag in all, if you would like to say. And within that space, what we like is like a kind of a Britannia, Colgate, Marico. These are companies which could come out with good numbers. HUL, with a wide product basket and presence across segments, should help the company achieve a steady growth. GCPL is our top pick in the space. Its focus on the non-agro commodities, for example. It's a large player in the soap segment where we believe margins would kind of improve and demand from the rural to pick up. So that's a kind of outlook that we are looking at in the overall consumer space.
Okay, so yeah, consumer, I mean, it triggered quite a bit of a debate, right, with the update that we got from Dabur. But just to press on that point, Siddharth, hi, morning and happy Friday to you. We've got the update from Avenue Supermart, and depends on how you want to slice and dice it, because Mangalam was telling us that maybe the market won't take that too well as well, looking at same-store sales, etc. So I don't know, if you got a chance to look at the numbers, what do you think?
Yeah, I think, yes, morning, Surabhi. So revenue growth definitely moderated. It is at to 14%, which is a 4% miss to our expectations. Revenue growth moderation, we believe, is largely due to the lower store addition in the past few quarters and the weak store productivity. We believe that the preference for convenience, that is your rapid adoption of quick commerce over value, would have contributed to the growth moderation for DMart, where DMart is clearly absent and is looking to increase its presence through the delivery channels, which is now we are seeing where a lot of growth is happening. So definitely some weakness in the numbers which the market may not like. But the overall, if you see the growth trend, that is pretty steady. So today the reaction could be negative. Productivity has also kind of been weak. For example, revenue per store at 1.5 billion rupees is up only 1% on a Y-on-Y basis compared to 4 to 7% growth that we have seen in the last 5 to 6 quarters. So, and to overall, the store addition also remains soft for Q2. The store number of stores added was about 6 stores, taking the total store count to 377. For the full year, we have an assumption of about 40 store addition. So definitely in Q2, the run rate in store addition was much lower than our expectations.
And what about Bajaj Finance? How would you read the Q2 update? AUM growth to 29%. It's slightly lower than the growth that we've seen in the last couple of quarters. And it's also uncertain on what the credit quality is going to look like, the credit costs. So thoughts on Bajaj Finance?
Yeah, Rima, I think Bajaj comparatively managed to give a better numbers. Yes, slightly lower than what we would have expected, but at an AUM growth of 29%, and nonetheless, in this environment is pretty good. So we believe that this growth might kind of enthusiast the market. A new client addition was healthy. This was the first normal quarter for the company with both the e-com and the Insta EMI card products available for the company compared to the previous 3 quarters where the RBI ban was there. New loans booked grew about 14%. And as I said, AUM growth was broadly in line with the expectation with up 29%. Yes, some concerns, especially if you look at on the credit side where the retail credit costs have gone up in the recent past, and that could be something that we'll get to know only after the quarterly results. But I think overall, we believe that the numbers are quite good in this environment. We had seen softer numbers in the previous few quarters, and with a 29% AUM growth, things looks much better for Bajaj Finance from here on.
All right, well, that is the view coming in on Bajaj Finance and financials. Sid, stay with us. We want to play out some more sound bites. With regards to the market fall that we saw yesterday, it was big and brutal. We had Harish Krishnan join us after market close at 3:30. He's the co-CIO and head of equity at Aditya Birla Sun Life Mutual Fund. And we spoke to him about, of course, this the big dominating driver for the sell-off that we saw yesterday. And of course, we kind of rounded it up with some of the themes that he'd still be comfortable betting on from a 2 to 3 year perspective. Listen in.
Over the course of the last 2 quarters now, earnings have actually not gone anywhere. For the broader markets in aggregate, even as markets have continued to climb up despite a poor election result, despite the capital gains tax and poor earnings trend. So I guess it is some amount of normalization is what one is seeing. The second, as you rightly pointed out, is the function of what's happening in China. Year to date now, China outperforms the US, India, in a surprising turn of events, right? 2 weeks ago, they were at 52-week lows. Come this week, they are at a massive 52-week high, outperforming almost all other markets. And this was a consensus sell, given various geopolitical measures and going into the US elections. And therefore, I guess some of the flow data that you spoke about, I think a lot of that has also got to do with the fact that there is some amount of serious money that is possibly going now towards China in the wake of a significant short squeeze that we've seen in Chinese market. So I think India is a low beta defensive market in the emerging markets. It typically does well when emerging markets flounder. It's like the FMCG of the emerging markets. So we think that there are 3 dark horse sectors out here from a 2-3 year point of view that we want to further add on to our positions. First is consumer durables. That's a space that we think has done quite well, but we think that there is more margin pickup story out there as a segment as a whole. Second is metals. I think we've come to a zone wherein the metal stocks have delivered quite well. The balance sheets are in very good shape. And I mean, of course, there is the Chinese stimulus angle, but even otherwise, I think that metal stocks are something where ownership levels are very low, and we would want to add on to that. The third is cement. This is a space where near-term earnings can look potentially disastrous, but this is a space where there is massive amount of consolidation happening. Again, a space where ownership levels are low, and that is something that we want to pick up into. On the sectors which were in momentum or which are in momentum and which can continue and where we want to add on and buy on dips, I would say IT would be high up on that list. We also think pharma is an area where we want to add on dips. Third would be capital goods. Fourth would be auto, and real estate selectively we would be looking at buying on dips. So these are the broad sectoral, sectors, kind of a footprint that we would want to buy on dips into this fall in anticipation of creating greater value to our unit holders.
Okay, that's really the question, right? What do you buy when you get the chance? The buy on dips question that we put to Harish Krishnan yesterday. Let's ask Siddharth exactly the same thing. Siddharth, Harish was talking about sectors when he can't talk individual companies and stocks. Will you tell us stocks? One or two good names to pick as the dust settles on China, Middle East, crude oil, all of that. But fundamental picks right now in this market.
Yeah, so if you look at some of the sectors that we believe could do well, IT is one of them where the green shoots are seeing visible with the growth coming back with the Fed rate cut starting and consumption discretionary spending on the rise. So we believe that Q2 revenue growth for IT sectors could be decent. Client spending behavior is showing positive trends indicating potential return of modernization, especially in the discretionary spending in some of the pockets. And among the tier one players, we believe HCL Tech can be a better pick given its strong capabilities in data engineering, ERD offerings, the ERP modernization, as well as making it well suited for the pre-Gen AI spending. So we expect HCL Tech to see a broad-based growth across verticals as well as geographies. There could be some pockets like BFSI where the growth could remain soft. But overall, we expect a good growth. Margins are likely to see a 30 basis points Q-on-Q improvement. And we expect the company to maintain its growth guidance about 3 to 5%. So we like HCL Tech between the tier one IT companies. We have a buy rating and a target price of 2,200. So that's a space clearly that looks kind of pretty good in the current environment.
All right, Sid, stay with us and we'll come back to you. We'll discuss more. There's the HDFC Bank numbers, which Abhishek will join us to shed more light on. And we'll take that break also. 15 minutes to go for the market open, the pre-open that is. Prakash Gaba and Shrikant Chauhan will join in for some technical trading ideas. Stay with us.
Welcome back. After a 2% fall in the benchmark indices, that we had yesterday, the GIFT Nifty will come up for you on your screen. Most of Asia has actually opened up in the green and it's trading in the green right now. So Hang Seng has now pushed its upward move to a 2% gain. Kospi Nikkei up nearly about 0.5%. The GIFT Nifty is currently down close to about 50 points. If it opens in the red, it would be the 5th consecutive day of losses for the benchmark indices. Prakash Gaba and Shrikant Chauhan are now joining us on the show now. Gentlemen, morning and thank you for joining in. Prakash, do you think markets are a bit oversold or do you think they could extend on the way down? What would be the Nifty trade?
Good morning to you and good morning to you as well. Nifty, when you look at the indicators, yes, it is oversold. Can it go down? Yes, it can go down. Just because it's oversold does not mean it cannot go down. Structurally, when I see something, I see gaps. Gaps are sign of weakness, and we saw a gap on the way down. Now, Nifty is trading somewhere close to 25,266, which is not a very strong support zone. It can still slide down. And the next logical technical target on the downside is closer to in the vicinity of 25,000. So it can go to 25,000. It can stall there. It can see a bounce there. But I will still doubt the bounce unless see some strength. So far, it looks weak to me as far as Nifty is concerned. 25,000 is possible. But when I look at the Bank Nifty, exactly similar is the case, trading somewhere closer to 51,900. But I think still weak. There's a gap on the way down, so downside should continue. The next logical technical target should be in the vicinity of 51,000. Perhaps we could see some kind of stalling there. The downside could stop there. That's what I see. But looks weak to me.
So, Prakash and Shrikant, morning. Prakash, so you wouldn't want to do anything today? I mean, no trades on the indices?
No trade on the indices because unless I see some strength, I'm not buying it at all. I could buy somewhere closer to the supports if I see some strength there. Until that happens, stay out or wait for around 75 minutes and then take a call, mark your points and trade points accordingly. But wait for around 75 minutes at least. Stocks, I like two. The first stock that I like is Colgate. It's a very defensive bet. Missiles could fly anywhere, doesn't matter. I'm going to still use Colgate, not using Datun. So it's a safe stock, more of defensive bet. Colgate is trading at 3839. I would have a stop somewhere closer to 3,800 or 3,750 and play it long for a couple of days. We could see levels closer to 3,900 first and then perhaps 4,000. So Colgate is a safe bet, one. Second is Jindal Steel. Again, buy. Seen an up move. Kind of a consolidation for around 2 weeks in the sideways zone. Yesterday in the down market, it was up, trading at 1,048. Would have a stop below 1,020, somewhere closer to around 28 rupees or so. Upside to 1,100 is possible in Jindal Steel. So yes, two stocks, Colgate and Jindal Steel.
Shrikant is also with us. Shrikant, would you have an index trade or is it an avoid?
Yeah, good morning, Riva. Good morning, Prashant. I think, see, for Nifty, yes, it is down. It is completely oversold. But at the same time, 50-day simple moving average acted as major support whenever there is a panic sort of situation in the market. This time also, there is like pressure and we are already down by almost 1,000 points from the highs. So close to 25,000 levels or 25,050 levels. If we see any reversal formation, then there we should look for taking some long bets in the markets. But yes, at current levels, it is better to stay away because the pressure is still on and we are in between. So close to 25,100, 25,000 levels. There we can take some contra bets. For Bank Nifty, there also we are seeing weakness because it comfortably closed below the mark of 52,000, which is something negative. So based on that, the next level to watch out for would be maybe 51,300 to 51,000. So around those levels, and these are the corresponding levels to the levels of 25,000 on Nifty. So I think around those levels, we are seeing some buying interest in the market. And if there is any pullback because of any reason, then close to 25,500, we should look for reducing some long bets.
Hi, Shrikant. Morning to you and to Prakash. What about the stock picks? Shrikant, what's your list looking like today?
Good morning, good morning, Subhi. I think, see, like from the specific stocks on the stock side, we like ONGC. The reason is because the crude is consistently moving upward, and if we consider and if we go through with the chart of Brent crude, then it is clearly indicating us that we are going to see further more gains. Maybe it could be somewhere close to $80 to $83 per barrel. So if that is like that holds true, then ONGC can do much better from here because the overall trend for the stock is stronger. It was down mainly because of downward weakness in the crude prices, but now again the stock can move up to the levels of maybe 315 or 316. So at this level, ONGC is a buy with a stop loss close to 280 on the downside. And the other stock on which we are bearish is Ashok Leyland. The stock, after very long time, closed below the 200-day simple moving average, which is indicating us that the stock can fall to the next levels of maybe 220 or 215. So at this level, Ashok Leyland is also a sell with a stop loss close to 236.
Okay. We've got Soni Patnaik of JM Financial Services also joining in to lay out the F&O setup for us. Soni.
Hey, good morning, Reema, Surbi, Prashant. Thank you so much for having me on your show. I think Nifty can slide down to 25,000, which is its next crucial support. And on the upside, there's a strong resistance forming around 25,450 to 25,500 odd levels. So at this level, it is wise to go with a hedge strategy where you see a buy and a sell idea. The first buy idea comes in from the pharma space, which is a bit defensive right now. And the stock is Dr. Lalpath Labs. So we've seen it adding up good long built up positions on day-to-day basis. And it has been sustaining above its 3,400 option chain breakout level. So one can buy Lalpath Lab in futures and in spot level as well. Keep a stop loss of 33.40 in spot level. Look for higher targets of 3,500 to 3,550. The second idea would be a sell idea in United Spirits, which has seen a breakdown below 1,600 levels. So it's an option chain breakout. So one can sell United Spirits in futures up to levels of 1570, 1575. Keep a stop loss of 1,600 and look for lower targets of 1,520 to 1,500.
Okay. All right. Thank you very much for joining in, and wish you a good trading day, Soni. Take a break on that note, come back on the other side. We'll have the pre-open rates, and we'll also connect with Abanish Roy of Nuvama Institutional Equities. The Dabur fall and the issue the Dabur flagged off with respect to inventory, is that a one-off or does it signal a wider trend? We get chatting with Abanish in just a bit. Welcome back. Well, 17 minutes to go before the action kicks off, and in a bit we'll get our pre-open rates as well. Siddharth Khemka has been with us. Siddharth, we've discussed, of course, Bajaj Finance, but a whole host of other NBFC and bank updates have come through, right? What is the sense you get in terms of this whole fight for deposits, what NIMs may move, how NIMs may move? And for some of the smaller lenders, like I was looking at Suryodaya Small Finance Bank, I mean, there the pain and pressure on the microfinance side is really showing up. So what are your top picks and what would you avoid this season in BFSI?
Yeah, Surbi. So I think overall, if you look at from the financials perspective, earnings growth are likely to be modest, while the asset quality trend could be divergent. What we are expecting is the system credit growth at about 12.5%, while deposit growth could be better at about 12%. And what we have seen that the deposit growth could be in this range of 11 to 13%, and that has been the range in the past 14 months. So what is happening is that asset quality for the large private banks as well as for the PSUs, that remains stable. However, for the MFA, the microfinance as well as the unsecured loans, they are experiencing rising stress. And some of these small finance bank, as you highlighted, they are more on the MFIs and the high risk segments, which are experiencing more increasing asset quality stress and leading to higher credit costs. Within the private banks, what we are seeing is a steady growth. We are expecting pre-provisioning operating profit growth of about 12%, NII growth of about 11%. As I said, for the private bank, slippages would largely remain under control. Similar is the story with a lot of these private public sector banks, where we are expecting a steady quarter. But small finance bank, there could be mixed performance. Some of the microfinance facing companies are experiencing higher elevated credit costs and slippages. So overall, our top picks within the space, in the private banking space, ICICI, which has been a consistent performer, aided by a strong growth and profitability in the past. We have seen that slippages has been under control, and the bank has outpaced the system credit growth, driven by good growth in the retail, SME, as well as some of the other segments. And overall, the return ratios are pretty strong. ROAs of 2.2%, ROEs of 17%, and valuations, although a bit on the high side, we believe that with the strong performance and leadership in the current market, it could continue to trade at the premium valuation. So clearly, ICICI Bank is something that we like within the banking space.
Got it. Okay, so that remains one of your preferred picks. Good talking to you this morning, Siddhartha. Thanks for joining in. Have a good day, and we'll look forward to connecting again. Okay, now it's time to put the spotlight on the FMCG space, and in specific, Dabur. and what Dabur's Q2 update really tells us. Let's get the numbers back in and actually the commentary as well. We have Abneesh Roy joining in. He's, of course, Executive Director at Nuvama Institutional Equities. Abneesh, hi, morning. Thanks for taking the call. And we're going to flash the Dabur commentary as we start the call. Now, what did Dabur say? Dabur is saying that sales are going to drop by mid-single digits. And they, I think, flagged off two issues. One is monsoon, so the beverage uptake was not as much as they would have liked. The second is this issue of inventory. They're saying that general trade got hit because of higher demand from quick commerce. And I think some inventory sort of management going on over there. What did you make of it? And the question is this just an inventory-specific, beverage-specific issue for Dabur? Or does it signal a wider concern for the rest of the sector and the rural recovery?
Sure, thanks. So first is we don't see this across the sector. So this is more specific to Dabur. In fact, we had highlighted last week itself that beverages will see a weak quarter, and that's why even Varun Beverages, we expect India volume growth to be only 5%. And even for Tata Consumer, Narishco will be soft quarter. And even for United Breweries, we expect 6% volume growth. So this was a result of very high rain. So we saw 8% higher than normal. So out-of-home travel was also difficult, and clearly the temperature was colder. Now coming to Dabur, I think apart from the beverages being slower in both Q1 and Q2, due to which the inventory got built up, and that's why there was a mismatch between the primary and secondary, they had to take this correction. Now in FMCG, pipeline correction is not something which is rare. It keeps happening, but the extent which Dabur took was very surprising. My sense is Dabur's forecasting across categories in terms of sales and demand, I think that needs to see some improvement. And we need to see consistency in terms of growth coming back from Q3 and Q4. Then the stock will re-rate. So we have seen 4 business updates in the consumer, 2 retail and 2 FMCG. So I can see 2-3 themes there. One is in urban demand, there is some level of slowdown. So what Dabur has highlighted also is that quick commerce is taking share from the general trade. But my sense is because of high food inflation in the perishables, vegetables, etc., and the telecom hike, urban demand, there is some level of slowdown, and it is slower than the rural demand for most FMCG categories. Rural, there is some improvement. So that's why if you see Marico reported 5% volume growth, we expect Godrej also to see.
Abneesh, sorry, I'm apologies for interjecting. Just to make it very clear, one step at a time. First of all, the inventory issue and the softness, is that a Dabur specific issue? Yes, no, or is it a hazy answer?
Yes, it's a Dabur specific issue. So you will see a slight impact, say, on the other beverage companies, but this is more a Dabur issue. And that's why if you see Godrej Consumer, which is also in FMCG, we expect 6 to 7% volume growth, HUL 5%. Britannia, for example, we expect high single to double-digit kind of volume growth. Bikaji, again, double-digit volume growth. So all are in the broader FMCG. So this is more of a Dabur-specific problem.
But you're highlighting at the same time, while this is a Dabur-specific issue and others will probably have a decent Q2 growth, but at the same time, you're also saying that there is some slowdown in maybe in urban demand. That's the point you're making?
Yes, in urban, we are saying that in FMCG, there is some level of slowdown, which could be because of very high vegetable costs, say, in Q2 and the telecom hikes. In rural also, if you see telecom hikes are there, but for them, the perishable vegetable cost is not that relevant because locally produced. Plus the freebies given by the local state government and the central government, they are more than overcoming any impact of the telecom hikes. So rural, there is a recovery.
You know, before we get to Avenue Supermarts and what you made of the Q2 update there, just to complete the point about Dabur, how is QSR hurting general trade? Do we have any kind of anecdotal evidence? Because QSR spends are on the rise. So, you know, what are your channel checks suggesting, and how much of a concern is this going forward?
I think your question is on quick commerce. Yes.
Quick commerce, yes.
Yes. So there is an impact of quick commerce definitely on the general trade. And companies are taking proactive steps to harmonize both. I think the quick commerce and the e-commerce and modern trade will keep gaining market share from the general trade. In fact, in big cities, now it should be bigger than general trade in many cities. So clearly, consumer is going towards convenience, and definitely companies also have to harmonize. That's why I don't think this is sector across sector problem which Dabur has faced. And this keeps happening generally when there is back-to-back 2 quarters of beverage slowdown. So they built up a lot of inventory and then they try to meet up the volume demand through other categories. That did not happen because every category there is competition. Again, in same quarter, Colgate we expect, for example, 7-8% volume growth. So it is not across the thing, but definitely general trade, there is some level of slowdown. And my sense is some part of it is market share loss to quick commerce.
Okay, and what about Avenue Supermarts? You're not very convinced about the like-to-like growth seen. Lay out your analysis.
Yes, definitely. We expect Avenue Supermart stock to be soft in the near term. There was a miss of around 3 to 4% on most of the metrics. If you see sales growth of 14% versus previous quarters run rate more like 18-19%, there was a 4% kind of a miss. And when we do the maths in terms of sales per square feet and sales per store, because these are the metrics which are available, again we see that sales per square feet was only 1% in terms of productivity improvement, versus earlier quarter it was more like 4-5%. And similarly in terms of sales per store, it was 3-4% lower. In terms of store addition for Avenue Supermart, I am not unduly worried. It is generally back-ended and they will get it right in Q4. But in terms of why this miss happened, this could be because there is some level of urban slowdown, and definitely quick commerce, Swiggy, Zomato, Zepto, etc. are expanding to more cities. They are more aggressive. So it could be that. It could be a mix of both.
Abneesh, just stay with us. I'm going to ask you about your sort of top ideas here as well. But let's just rewind the clock back and look at what happened yesterday, right? I mean, so that's also the big one, which is the flows picture, the big selling that we saw. Hormuz has put together some data. Hormuz, take it away.
One of the biggest factors for the sell-off that we saw on Thursday was this relentless selling that is coming in from the FIIs over the last 3 sessions, almost $3 billion, and almost $2 billion of that came in yesterday's trading session. 15,243 crore in the cash market is where the FII selling figure was, but almost all of it was concentrated into 5 large cap names, and the index heavyweights dominate that. Look at Reliance Industries, HDFC Bank, ICICI, Axis, Tata Motors, all of them cornering a large share of that focused FII selling that we saw in yesterday's trading session. Now, yesterday's selling was also the highest that you have seen from foreign institutions in the last 4 years. That is almost dating back to the COVID period is where you have seen this kind of selling from the FIIs. And if you could look at the data as well from this year, where you have seen the first 2 figures coming from January this year, which is right before the budget, on the 4th of June, of course, which was the day of the Lok Sabha election results, and of course then towards the end of September, which is when the downfall actually started after the markets had made new highs. Now, where has this, but most of this selling is attributed to money moving out of India and going into China, but not everybody is convinced of this China rally, and Rajiv Jain of GQG is one of those, and he mentioned this, and he's been underweight on his funds in the Chinese markets, and he's mentioned this, that how many times in the last 3 years he's seen this excitement only to dissipate going forward. He calls this a trade, a very good trade, but if he says that if this party goes on without them, they're fine with that, but it's a trade and there's nothing more. Is this really that something can be invested in the next 3 to 5 years? But Citi has come out with a view. They're saying that this Chinese outperformance, this CSI 300 up almost 24% in the last 1 week, supportive policy announcements, and this rally has led to the Chinese markets catching up with the Indian markets over in terms of share, in terms of returns. And they also say that strong macro growth and outlook is going to be supportive for, and resilient domestic inflows will keep the Indian equity supportive as well. And Gavinkel Research has also come out with a view. They're saying that even if China continues to sustain its rally, they're saying that many foreign investors continue to remain reluctant to invest there, and the headwinds that China is facing will become a tailwind for the Indian markets. And the last caveat that they add is, while foreign investors can definitely find value in other emerging markets, it is too early to call time on India's bull market.
All right, Hormuz, thanks very much. And of course, as they say, the OG, Stanley Druckenmiller, speaking at a conference, this is day before yesterday, also essentially said that when asked a question, I mean, it's also about what they're asked, right? And they respond. Essentially said that as long as President Xi in China is there, he's going to stay out. So in that sense, echoing what Rajiv Jain of GQG said, happy to miss out. There are enough other opportunities. You can't be everywhere, you cannot be. And perhaps should not be as well. So those are some views coming in. But that FI number also, the past large episodic outflows, as Hormuz pointed out, it's very large yesterday, but we've had these before as well a few times this year. Abnish is with us. Abnish, thanks for waiting. So let's just zoom back on and since we're talking about China, somebody was talking about, say, for example, a company like Meituan is trading at. Valuations, market cap, and then you were looking at what Zomato here is trading at. So all kinds of things in the mix, just in terms of conversation. But of course, what we can do and our investors can do is take a call or not, whether they should buy names like Zomato and others. But what are your top ideas, top picks, Abnish, from here on in the space?
Sure. So we remain positive on FMCG. Next 4-5 years, there is a coalition government at the center. There is competitive politics, populism at the states. We have seen freebies definitely increase. Good monsoons. So we are preferring companies which have higher exposure to rural. So currently we like Colgate, we like HUL, we like Bikaji, Britannia and Imami. Those 4-5 names will be the top ones in the staples. From a Q2 perspective, we'll be underweight on the Asian Paints and Berger Paints. Again, because of very high rains, the exterior paint demand has been impacted and there is a down trading. And the stocks had run up quite strongly because of the lack of success of the new players and crude oil correction. Some bit is now reversing there. Nestle also, again, more urban focus. So we'll be a bit cautious there in the near term. So the top buys will be essentially rural focused companies. In the apparel, again, value apparel. So Trent and V-Mart will be the top buys.
Okay, thank you, Abnish, for joining in. One stock of the day is going to be HDFC Bank. Just came out with their Q2 update. Abhishek joins in with the key highlights. Abhishek.
Well, the entire focus of HDFC Bank is on deposit mobilization, and if you take a look, that has been pretty strong for them. And their also focus is on reduction of credit deposit ratio, and that's also seen in their results, which is the prelims that have come in with respect to business updates. So deposits are up 15% YOY, but more than 5% on a sequential basis. The CASA is up 8% YOY and about 2.3% sequentially. However, due to higher non-CASA growth in terms of deposits, the CASA ratio has declined to 35.3% versus 37.6% on a YOY basis and about 36.3% on a sequential basis. So the time deposits or term deposits is up 19.3% YOY and about 6.7% sequentially. Now the advances growth have been tepid, and we have been seeing them selling their loan book sell down has been happening. So that advances growth is at 7% YOY and about 1.3% sequentially. AUM growth is at 8% YOY and about 2.3% sequentially. The entire focus looks to me on credit deposit ratio, which has declined sharply to 100.8% versus 108.4% in the same quarter last year and about 104.5% in the previous quarter. Even the liquidity coverage ratio, that's improved to 127% versus 123% in the previous quarter. Back to you.
These are decent and good set of ratios, especially the CD ratio coming back to more reasonable levels now. Abhishek, thank you very much for that. I think we are just hitting market open and we'll have the values coming up in terms of first rates in a bit from now. Lots to track. The market itself, the pre-open is left about 70 points lower, so 25,000, just under 25,200. And I think about 5 days back we were at 26,200. So that's how quickly markets, of course, move nowadays. Just a few seconds and we'll just read out the indices and then we'll do stocks. What do we have? First rates, 25,211. It's a flattish start, 0.15 lower. The Nifty Bank is down about 0.25% and nothing. I think the Nifty is now turning into the green. Let's see. Bank Nifty 51,865 is where the Nifty Bank is at. The mid-cap index is absolutely flat, nothing, no change. So 58,964 in the mid-cap index at this point. The IT index, which of course will be first off the block in terms of reporting earnings with TCS next Thursday, the IT index is up 0.5%, 41,980 or so on that one. So that is a heavyweight. The Nifty heat map is coming up on your screen. I think it's more down than up, but this is the first 1 minute or so of trade. Market on the Nifty is already up about 30 points. which is a little better than how the absolute first rates that we got. So 25,270-ish on the Nifty. Surabhi.
Now, the interesting rates are on companies that have come out with their quarterly updates. Watch out for Mahindra and Mahindra Financial. The market does not like any hint of deterioration in asset quality, which is exactly what M&M Financial has reported. Stocks down 4%, and Avenue Supermarts also down about 2.5%. So we'll sort of talk more about these updates and the impact. On the large cap screen, actually, speaking of updates, why I forget Bajaj Finance. Even here, despite that 29% AUM growth, the stock is under pressure, 2% lower, because the internals seem to be not that pleasing for the market. BPCL is cooling off after yesterday's sharp rally, 2% down. Trent, Asian Paints, Reliance. Reliance has had a very volatile start. Reliance was actually up, leading the Nifty higher on the green side when we opened, and it's immediately turned course and it's down 1%. So intraday, this move is already about 2.5% on Reliance for such a big stock. Anyway, ICICI Bank on the lower side. There is some selling on HDFC Bank as well. So banks are not supporting, and the market has started slipping. There's Bajaj Auto, Hero Moto, the two-wheeler makers, Eicher, all of them on the way down as well. Nestle, Britannia, Tata Consumer. If you thought consumer will support, well, that is not the case at this point in time. On the upside, what remains is actually ONGC. And there's a fair amount of IT, like Prashant pointed out. So TCS, Wipro, they're still trying to provide some comfort and support. Tech Mahindra, minor gains. But otherwise, it's just cooling off. Barring ONGC, which is a very obvious move on oil and IT, the rest of it, banks are slipping, Reliance is slipping. We don't have too much support. And even FMCG, not really helping the bulls' cause, at least at the open.
Well, M&M Financial is extending its losses now. So more than 4% gone on M&M Financial. Apart from the worsening of the asset quality, even the disbursements for M&M Finance in Q2 were down 1% on a year-on-year basis. So a bit of growth concerns too. Angel One too is reacting adversely. That stock is open with a cut of close to about 3% odd. Paint companies are hurting on the back of the rise in crude prices. So Kansai Nerolac, Indigo Paints are down 1.12%. EPAC Durable has got an order win or sort of an agreement. They will be manufacturing components for Panasonic ACs. It started trade in the green, but now has dipped into the red. So perhaps some of the up move has already played out, because this week the stock is already up close to about 7%, and the stock is practically doubled from its IPO price. Interglobe Aviation too is a bit subdued in trade, so that's open with a cut of about 1%. Z Media, a stock which has had a one-way unstoppable move. Z Media today has corrected close to about 5%, and some cuts are coming through in real estate companies like Macrotech Developers. Real estate index, remember, has taken the biggest hit over the last 4 or 5 days. So Phoenix Mills, Macrotech Developers continue to remain under pressure. On the way up, it's ITD Cementation. Yesterday was up 20% on the back of that 1,900 crore order win. It's followed it up with another 5% gain. Sapphire Foods, JK Paper, these are stocks which are looking quite smart and seeing some pretty good volumes. Aarti Drug, Shilpa Medicare, even Uflex, where the company is planning to set up a plant in Egypt. The investment will be $126 million. Uflex is higher by close to about 1.5%. And Bank of Baroda, amongst the Q2 updates, Abhishek, remember, was telling us after a weak Q1, in Q2, growth has bounced back. The company's advances growth is 6.7% on a quarter-on-quarter basis. So Bank of Baroda stands out on the way up in terms of the quarterly updates.
Okay, well, those are lots of names which are coming through. Just a few more. I mean, look at the Nifty, right? We started absolutely flat, slightly lower. Then there was a 30 or 40 odd point bump. That's got sold into, and we're down about 80 points now. So 25,170 is where we stand at. So that's about 1/3% lower. So this is a more, not decisive, but a pronounced kind of reaction, for the first pronounced reaction for the day. Let's welcome in Samir Arora. He's joining us. He's a market master of the day, founder and fund manager at Helios Capital. Samir, it's good to see you. Thank you very much for being on the program. So I have two questions, and you are someone who's invested and watched not just India, but regional markets very closely as well, China as well. So let me start with that. Is this time different? That old question. It rarely is, but let me frame it that way for China. And second, I mean, is this a real thing? And second, flows. We saw some very large selling figures in India over the last 2 days, foreign selling. Is that on account of China as well? Go on.
So second part, not so clear, but first part is it can go on, I think. By the way, in our fund, we used to own Alibaba and and C-Trip, and we bought more Alibaba even yesterday because I think it can go on for some time. And actually, I don't think it's a bad thing if China market does well for us, as in mostly for India funds. But before that, so the China thing, first of all, the government has to take a call now whether they are going to make sure that they are able to revive confidence, revive this thing, or they make it as a given. They have the money, they have a lot of advancement in technology. They have to basically revive sentiment of the consumer. There was maybe some pressure even for people who were rich to not openly spend because of this shared prosperity and things like that. So if they let it go, like for India, for many years, we were able to say that although there is a big divide between the rich and poor, but at least the rich are doing premium and the care recovery and all that. So you don't believe that there are many super rich people and middle class and upper middle class, which all they need is the market. A market means the government and whatever to let them be as they are rather than always show that they are, part of a shared system. So it can go on, I think. And maybe some pockets do it only, but it can go on because their market was really cheap. It was just that it needed a trigger. But I think it is not bad for India per se. I don't think that beyond some shorter term thing, investors have to sell India to buy China. Because India, I don't think in aggregate people are overweight. There might be 1% plus minus overweight. So if you were underweight China, that would have come from the rest of the world. India and China, even an emerging market fund combined would be, say, 20 and 25, 26 now. So half the investment of people who are able to move this around is in non-India, non-China. The other thing is if the Chinese market does well, and if the US market does well, the Indian fund managers, the mutual fund guys, they will have less reason to sit on cash. Our premium to emerging markets, our premium to China has shrunk because the Chinese market is up some 25, 27%. So we are some 5-6% cheaper than we were. Just to finish one more line. So meaning the market used to say that Indian market trades historically at some 40-50% premium to emerging markets. And in recent periods, it has become 165-170%. So that does not mean it was 20% overvalued. That means it was 170 divided by 150. Correct? Because 150 is so it was 10-12%. Let us say, if that was one issue, that it was 10-12% more than the longer term average. Now that it would be, according to me, 5-6% more than longer term average, just with China moving up 25%, because that would have shifted the valuation by 5-6% at an index level for emerging markets. So I think you don't want China to blow up and feel happy on that. If they're doing well, it's okay. We may underperform, but we will not be in absolute negative.
But Samir, hi, morning. Great to be listening in to you. But the thing is, when $3 billion leave the market in 3 days, it does catch people by surprise, right? I mean, we were sitting on a high horse saying we don't need the foreigners and that's fine. We have local money. But exactly, I mean, we've forgotten what FII selling really feels like, and we got a nasty reminder since the start of October. How long can that continue?
But that's what I'm saying. I don't know whether it's related to China only, because there are three issues going on simultaneously. One is China, let's say, one issue. Second is that if people had some model on which they are doing this futures arbitrage and all these millennium kind of guys. And the third is that separately, I think it is going on in parallel that if you have more than 25,000 crores in India, you need 100% disclosure of your end investors. And many of these platform guys will have more than $3 billion and they have to basically reduce their weight in India. So who knows what is the exact reason? But I think the best answer for that would be to call some broker and ask him that, is it hedge funds who are selling? Is it long? Because my big picture thing, without overly knowing this, is that nobody does it like that. No regular long-term or even medium-term investor sells a market which is, at least in the last 3 weeks, zero, to buy a market which is up by the time he ends up buying it 30% higher. And mostly the stocks that he will like to buy are 40% higher. Mostly you do it a little bit more gradually. This kind of thing normally is a burst in the beginning, and that can be easily countered after some time with the domestic guy sitting on cash and some other guys who will feel that a 30% move is too big. I just think big picture, relative India-China flow is not going to do it, but who knows?
Got it. No, just one point. Hormuz was just telling us, he looked at the top stocks. He said 5 stocks basically were responsible for the, I think 70-80% of that 15,000 crore sell number. There was Reliance, there were the 3 banks, and there was, so very concentrated. And the fact that there were 3 banks kind of looks like it's a foreign related.
No, of course it's foreigner selling, but the question is whether it is China related or it is arbitrage related and other things.
Samir, hi, morning. So we're now almost approaching a near 5% cut from the top. And, you know, at least in the last couple of years, we haven't seen a fall greater than 5%. So now investors are saying that is this the time to buy stocks or buy any themes that they like? So, you know, if you have to find opportunity now in this little bit of a correction, what would you recommend?
So first thing is that 5% correction can happen without a reason. If this 5% correction has happened for reasons like Israel attack or Iran sending missiles to Israel, or it is because of Hamas and whatever, and it is because of China having done this, then it's a pretty decent market that with only 4-5% fall, it has absorbed all this. So I think the market continues to be strong because my big picture thesis is that India itself was doing okay. If the rest of the world is also doing okay, then there is no reason for us to feel too negative. The only issue could be this geopolitics, but as of now, even the oil prices are not that high, which show that there is an imminent attack happening, although President Biden said some few things which confused the oil guys for some reason. But coming back to us, so we, first of all, have been more or less fully invested, so we don't have much, but the general big picture thumb rule would be any stock that you own which is down 5, 7, 8% without any reason, you buy 0.5% more of that. For us, these stocks remain primarily right now in the financial sector because the IT sector, we have just bought, you know, now we have some 13, 14% in IT, but we need to wait for their results and guidance and language and how they say, because we have all taken it for granted that the worst is over and that there'll be some improvement from here, but let us again hear it from them. And in consumer, I genuinely think that there is a slowdown and that there is too much competition and we come up with a new excuse every month. Sometimes it is big rain, then big summer, then politics, then cold, because now they're saying it's very cold. So then they suddenly say, oh, let's buy some cream guy because somebody's skin became dry, so they want to buy those shares. So I don't like that. I like very, sort of somewhat reasonable prediction of growth or sometimes very high growth like these food delivery companies and all that.
You know, Samir, so I just looked at what is, this is of course as of yesterday's close and maybe today the numbers would be a little, so Axis, HDFC, ICICI, they've all fallen. Axis has fallen 8% from its highs. HDFC Bank 5.5%, ICICI 5.5%, Reliance 8% from the highs. Tata, and actually autos have taken a knock between 6, 7 and 8% average. Tata Motors, Bajaj Auto, Maruti. What you were saying, right? I mean, the pullbacks
so I would say that
seen.
autos should fall 20% as far as I'm concerned, and they would still be overvalued.
Yeah, you've not liked autos for a while. Yeah,
and that is very blatant. I mean, it is just too much of living in our own world. But for financials and even some consumer here and there, you can add, we will add, or we have added.
Okay, all right. This the other sort of thing has been earnings. So consumption is slow, but looking at some of the previews which have come in from specific sectors, generally it's expected to be a pretty slow quarter. Actually, people have mostly written off Q2. They're looking at H2.
So it's very easy to say now, as soon as the results are bad, to say they have written them off, because this whole quarter, the only stocks that went up were these consumer stocks because of good monsoon. Now they say there was too much monsoon. Actually, I have a bigger issue with this, which is to do with the fact that these traditional consumer guys, I think the basket of the consumer has changed into his, as in regards to his preference. So if there's more rain and somebody makes a few 1,000 rupees more, does he upgrade his toothpaste or does he spend more on a phone or on something which he can show on social media or in a photo, or does he travel a little bit more, or does he buy a more expensive shampoo or a soap. I think the basket has changed, and even this telecom price hikes have basically meant, say, a 300, 400 rupee per year price hike, say 30 rupees per month, multiply by 50, 60 crore people, and that is a big, big number that has gone to the telecom guys. So I think basically we are not interested in the old consumer companies where you are betting whether the growth is 3% or 4%. And that is also because of rain or no rain. And we don't like the consumer durable companies, because the consumer durable companies, the competition is just too much. Everybody wants to get into the same making of ACs and making of microwaves and making of air conditioners, from the French, not French, sorry, the Japanese to the Koreans to every Indian guy like Reliance, Flipkart, all going to the same underlying OEM manufacturers to make under their own brand. It's just too much.
Yeah. I just have since we have you, and I must ask you, there's this new F&O curves, etc., which have come in. Quick thoughts, if any, at all, on how this is going to work out. We will see big fall in volumes. And your thoughts on BSE, Samir, if you have a view.
So actually, I don't know about BSE, I don't have it, but big picture, my thing is that the market in India has to, for a few days, play dead on those sectors or stocks where the government or the regulator is trying to do something which broadly is negative. So let's say you increase capital gains tax. If within 2 hours the market goes up, it gives confidence to the government that we should increase taxes even more because these taxes were ignored. In the same way, if SEBI or the regulator is saying, I think the futures and options volume is too much and I have to cut it down, and within 2 hours the broker stock is up 5% and the stock exchange stock is up 8%, it gives instant feedback to the regulator that this was not enough.
Yeah, but Samir, to be fair,
you have to act that this is such a difficult thing for a few days collectively.
But to be fair,
it doesn't matter the next time. So I think both will be increased.
No, but to be fair, Samir, to be fair, these stocks went through a lot of correction, right? Because the announcement was just a culmination of a discussion paper. It went on doing the rounds for several months, and we saw the price damage on an angel.
I'm not joking, but I'm joking. What are you joking? On first day, you have to make it look that it was very tough and not.
Yeah, that's true. It's very, very onerous. Tax hikes, any higher regulation. You have to show that it's very difficult.
But Samir, you're giving the secret away. You're giving the secret. If you got to do it.
Because I'm a transparent guy, I tell everything.
But speaking of transparency, Samir, to round this conversation up as we move to our next guest, who's actually tracking equity markets around the world, CLSA's chief equity strategist. So as we move to Alexander, I'm coming back to the final point, Samir. You are still buying Alibaba, right? So for every incremental, you bought yesterday. So that's the question. That for fund managers, that for all the new money, even if it is tactical short term, are you going to buy China shares or put that money to work here in India?
No, that's what I'm saying. It doesn't happen like that. That fund doesn't buy India. It's a global fund and all. I'm saying India has enough story and an ongoing thing for the world to not take it as a trade-off. And by the way, how much Alibaba we bought compared to what we buy in India, the proportion might be 30:1 or something. So the point is that what I'm saying is the fact that China is doing well for a few days, yes, for maybe 10 days, 15 days, it can happen that somebody who's really was short there or really was underweight doing it. But just like you saw today, the GQG guy saying that it's a trade, not everybody will buy into it. And particularly the bigger guys, the endowment type or whoever has walked out of China on some serious view that they have of that market are not even time-wise able to change it in a few days or in a few months. So this will go on, life goes on, but overall it's not a bad thing for China to do well. I mean, because you need the rest of the thing to work well so that we don't stand out also beyond a point that our premium is so much, we are at all-time high relative valuations. And
as they say, nazar na lag jaye, Samir,
right? Correct. You have to let it come along.
Super.
All right, thank you very much, Samir. It's a pleasure speaking with you, and hope we can do this more often as we continue to track what's happening in, China, India, and of course everything else. 3-4 things up in the air all together, guys.
Okay, let's move on then. And as promised, CLSA, let's get the conversation going. CLSA in a recent note said that the China stimulus package is a good start, but not a panacea for China's issue. They added that the constraint on stimulus is already stretched budget and elevated public debt. To discuss more, this and more, we have Alexander Redmond, Chief Equity Strategist at CLSA, joining in. Alexander, thank you very much for joining in. This is Rima here. I think that's the big question now. What we've heard from China and what perhaps might come in the future. Is the Chinese market, should we look at the Chinese market tactically, or is it good structurally for the next 3 to 5 years? Wayne, with your opinion.
Yeah, very good morning. Look, I think that is the key question. What we've seen so far is a commendable delivery on the monetary policy side. We've seen some direct stimulus at getting the equity market animal spirits back alive, and certainly the retail investor has followed through on that. But I think what really differentiates the current episode is going to be whether you get the fiscal follow through from the Chinese government. We've had 4 full storms, so 4 bear market rallies in Chinese equities since March 22. And each one has petered out after about 3 or 4 months and after no more than about 40% gain, as the market has come to the realization that the fundamental economic challenges that China faces have not actually been resolved. What will differentiate this one is if in the next weeks and months we get some clarity from the Chinese government, from the key policymakers in the Politburo, as to the magnitude and the scale and the deployment of a large fiscal package. Because let's remember, I mean, China's single biggest problem that it faces at the moment is immense oversupply on the real estate side. If you look at the current inventories with developers versus the current rate of sales, it represents about 3 years worth of inventories that they've yet to clear. And that doesn't include the 12 to 15% of the housing stock in China, which has been bought speculatively. So add all of that up and you've got a lot of inventory to digest, and you need a sizable fiscal package aimed squarely at local governments to be able to digest that. In other words, buy it off developers and turn it into social housing projects.
So, Alex, great to have you with us here on the program. So you're saying we need to obviously watch the property market very carefully to see if there is any sort of a durable rebound. Is that going to be the best indicator of whether this is the real thing? What else will tell us that this is the real deal?
I need to see multiple changes and indicators. I mean, what we need obviously is for property prices to begin to turn up. Certainly, I mean, this is critical. 51% of household wealth in China is still sitting in property. You know, as a member of a Chinese householder, going to feel sufficiently confident to go out and acquire more property if prices are still falling? You know, highly unlikely. But equally, what I would like to see is consumer confidence broadly begin to come up, and also importantly, consumption. And this again is, I think, a key topic, because as we're all aware, China's economy at the moment is still remarkably imbalanced away from consumption. Its consumption share of GDP is only about 56%. If you look at the other large global economies, India included, it's between 70 and 82. So China needs to take policy measures which will unlock savings. At the moment, you have about 115% of GDP sitting in savings. So much of that could be deployed into consumption. It's just whether the government is prepared to take those steps to actually unlock China's consumption potential going forward.
But would you say to some extent this China rally that we've seen is a bit of a hope trade, because this fiscal stimulus package of 2 trillion yen, which has been talked about, hasn't been officially announced by the government there?
Mm-hmm. No, you're right. I mean, what we heard, the genesis of the report, I think, came from Reuters. There was 2 trillion renminbi, split roughly in half. I mean, the idea was that half would go to refinance local governments and allow them to carry on the purchases of excess real estate inventory, and the other half aimed more at stimulating consumption. But as you say, this remains unformulated. I mean, last Tuesday, you had a relatively precise delivery on the monetary policy side and regulatory changes from the PBOC and the securities regulators. And then on Thursday, we had some sound bites that came out of the September Politburo meeting, all about arresting the falls in real estate and trying to encourage spending in China. But as you say, pretty light on detail.
Okay, so got that. So you've spoken a good bit on China. Alexander, the question really is for us sitting here in India is what does it mean for us? And we've seen the first sign of real FII selling in the last 2-3 days. And I go back to a call that your India analyst Vikash Jain made, that he said the quote-unquote Modi stocks, they are perhaps most vulnerable to profit-taking. So what's the stance on India?
I mean, India's been on a roll for several years now. You know, we've been a structural overweight. We've enjoyed that rally, but I've always been testing that because there is a certain amount of complacency around, or at least has been around the Indian equity market story, and a certain amount of consensus. And there are three things which I've been looking at to break that complacency. And essentially, it's an interruption to retail investor appetite. A large pickup in issuance. In other words, you get IPOs to the level that you can swamp the secondary market. And also any changes to the oil price. And what you've seen actually in the last week or so is all three of those come into play. So you've seen regulatory changes which have dampened the ability of retail investors to participate in equity derivatives. You've seen the geopolitics in the Middle East become more of a flashpoint, and that's aggravated the oil price as we all sit now waiting for Israel's response to Iran's missile strike. And you've seen significant pickup in primary traffic. So, the volume of IPOs and secondary issuance has picked up as well. So all three of those, I think, in combination are certainly testing the Indian market. And as you say, compounding that, there's certainly some scope for rotation. Now, I think we need to be careful here because if you look across emerging markets, India is one of the most domestically owned markets, and that is quite a moat for India. It's very protective. 83% of the market is owned domestically. I mean, if you go to Latin America, that number falls below half. And so with only about 17% of India owned by foreigners, and most foreign investors actually sitting, at least anecdotally, at underweight positions because they find it difficult to stomach the valuations, I think there will be relatively little drawdown on Indian equities to rotate into China. I see a more obvious source of that being Japanese equities or Korea or Taiwan as we get towards the end of this tech cycle.
Quick one-word answer, Alexander. On US elections, who's better for emerging market equities? Kamala Harris or Donald Trump?
Look, I think there are some key differences here. I can't really do it in one word, but I'll try and be brief. Look, the differences are, I think, obviously on tariffs. That's very well flagged. We know about that. But equally, there's some more nuanced differences. I think Trump's agenda is far more inflationary. He stands for deregulation, cutting taxes, implementing tariffs. And I think that what that will do is complicate the Federal Reserve's ability to ease in a Trump administration. So I think what would really differentiate Trump and Harris from an emerging market standpoint is three things. One, the Fed's capacity to ease. And that would have a knock-on effect on Asian and emerging market central banks' capacity to follow through. Secondly, the dollar, of course, because if the Fed is unable to cut as much, then the dollar will remain relatively strong, and that's always proved a headwind to emerging market equities. And thirdly, on the earnings side, what brought the EM rally to an end in 2018 was as much the start of the trade war as Donald Trump's tax cuts. He took the tax rate, corporate tax rate in the US down from 35 to 21. What that did was give a boost to US earnings growth. The relative earnings differential between the US and emerging markets then went up, and that made emerging markets overall look less attractive. So what really differentiates on the tax and earnings side between Harris and Trump is that Harris wants to take the US corporate earnings growth back up to 28%. Trump wants to cut it further to 15%. So under that environment, the EPS differential for emerging markets would look better within a Harris administration than Trump. So overall, I would conclude that Harris certainly, I think, is more favorable for emerging markets for those macro reasons.
That's a great point, Alex, and thank you for highlighting that, because there's so much debate around US elections. I think the central issue, which is tax, is perhaps not discussed enough. Thank you very much for all the perspective. Great having you on. We hope to have you more often on the show in the coming weeks and months as well. Take a break on that note, come back on the other side, and we'll connect with Ramesh Swaminathan of Lupin and talk about the company's business outlook.
Welcome back. I think just the one thing I want to say before I get to the next thing is the fact that the bank Nifty came back into the green. There was a big recovery. There has been a decently big recovery from the day's lowest point, and we are now sort of between green and sort of red. So absolutely flat for now. More on this later. Lupin is the first corporate on the program today. The stock surged more than 60% in 2024 so far. We're now joined by Mr. Ramesh Swaminathan, ED and Global CFO at Lupin, to talk about business and some of the developments. Mr. Swaminathan, good morning. First of all, apologies. Sorry to have kept you waiting with markets what they are. So, let's start talking about the latest, right, which is the MyBetric generic. Now, we understand that the US Court of Appeals, the judgment has gone against generic companies like Lupin and Zydus. Could you tell us what is the status of the litigation? Are you still selling this drug right now in the US as we speak? And what is your expectation about how much you will make from this in FY25 and FY26?
Firstly, let me begin by thanking you for having us on. Regarding Mirabegron, the first thing that I would like to state is that it's actually sub judice, so I wouldn't like to delve on it for too long. But I would say that we are indeed selling this drug, and we are pretty confident about our case. And from that perspective, we continue to sell it.
Okay. But this is still in the courts right now. So I understand you don't want to go too much into detail. But the Court of Appeals decision went against generics, right? So will you have to stop selling it at some point, or just?
It didn't go against the generics, and it got referred back to the same bench. So for the same trial courts. So it is not. I wouldn't say it is actually against generics at all.
Okay. Just one last. I won't press you beyond that. Estimates are that in FY25 you'll make between $120 and $180 million. Is that on track? Or are those wildly off those estimates?
It'd be an unfair question to ask, because essentially we never delve into product-wise details. Suffice to say that we are doing pretty well in the product also.
Okay. Morning, sir. If you could just give us a status on another drug. I think the kidney drug, Q generic. Sorry if I'm getting the pronunciation wrong, because we understand the innovator of the drug, Otsuka, has filed an appeal against a verdict that would have otherwise favored companies like Lupin. So what's the status here? Is Lupin going to launch the drug as you had planned in 2025? Or is there going to be a delay? Or would you look at an at-risk launch?
Just speaking about tolvaptan, the fact of the matter is you've actually won that case, and we are pretty confident about actually launching it. It is a pretty large drug. It's a REMS product, and from that perspective, I would expect it to be limited. It would continue for some time from our perspective, and very, very upbeat about that particular product for the next year.
So when are you launching it, sir?
It'll be possibly in April 25 next year.
And will this be an at-risk launch?
No, tolvaptan isn't an at-risk launch.
Okay. Mr. Swaminathan, hi, sir. Morning. Now, a slightly broader question. How you're seeing the US business overall sort of move along, and some of your, of course, marquee names like Albuterol, Spiriva generic, etc. So What is the prognosis going forward? And I just want to understand whether politics at all impacts business in any way when it comes to your US operations. Does it really matter to you who comes to power? And also tell us, because it's a little difficult to track all the minute details. For instance, our previous guest was just highlighting that in general, one camp is looking at a big hike in corporate taxes, while Mr. Trump obviously wants them lower. But on the healthcare side, in terms of policies, could there be any significant impact on generic company operations like yourselves?
Too many questions in the same breath. Let me take the first part of the question regarding how well we are doing. We continue to see pretty good buoyancy on the top line in America. So the recent launches, which includes, of course, our respiratory portfolio, albuterol, and then Spiriva continue to do pretty well. We've also bought into a few brands out there, Zopinax, Brovana. They also continue to do pretty well. In a general sense, we've also been launching a host of other products, OSD and the like. So if you look at, for example, we had Darnavi last year. This year we had, we had quite a few other products. In this year, for example, we are looking at, some ophthalmic products as well. Next year, we're looking at tolvaptan. And of course, when you speak about, in fact, the entire respiratory portfolio, we are actually working on the entire range of products in that portfolio. And over the next 5 years, we'll be launching a number of products. Apart from that, we also have a number of products on the injectables front also. So from our perspective, we're still pretty bullish about the overall prospects for America. And that would be true with, in fact, the other markets as well. But reverting back to your question about the political situation out there, we believe that affordable medicine is certainly going to be, the case, irrespective of whichever party is in power. So be it the Republicans or is it going to be Democrats, I don't think we're going to be impacted at all. There's of course the IRA and other acts, regulations which might actually impact the ethical companies, not so much the generic companies, because we are all about affordable medicine, and that would not impact us so much.
So, sir, the estimates on the street right now, the analysts are working with estimates of, say, $220 to $230 billion of a quarterly run rate for your US business. Are they fair estimates or are they conservative? Can you actually do better than that? I'm not asking for this quarter, but generally that's the assumption for the next couple of quarters.
I would say that given the pipeline that we have and given the fact that the respiratory products will continue because they're a lot more sticky, I would say the run rate that we saw last quarter would certainly continue in the future as well. So 200, 220, 225 would certainly be the range for the next few quarters.
And around 21% in margins for 25 overall?
Last year, last quarter, for example, we did 23, but we also kind of guided that it could perhaps turn out to be a little lower in the quarters to come because of the fact that last quarter, the overall R&D spends were a tad lower than normal. So given that we were guided for about 20.5 percentage points, very confident that we would actually be on track to achieve more than that.
Okay. You'd also indicated that you could look to spin off some adjacencies like OTC, diagnostics, digital, etc., and get in outside investors. Any movement on that?
So let me put it this way. A capital allocation policy has been predicated on what the board really wants. And when I speak about, in fact, the adjacencies, diagnostics, digital, all of this are very important to us. But having said that, these are not going to be the dominant themes. From that perspective, there is actually the upper threshold in terms of investments that have been kind of prescribed by the board also. We will not be exceeding that. So we already spun it off into subsidiary companies and potentially be looking at involving private equity houses or other passive partners to partner in the journey so that they kind of spin on their own axis. So the idea is, of course, to benefit from these businesses without actually losing sight of the fact that our capital allocation policies should not be kind of dislodged. So it's basically that. So we are confident that when they reach critical mass from our overall size perspective, we should be in a position to kind of place it with outsiders.
Okay, just a quick word. I think the US FDA inspected and issued 3 observations for your Pithampur Unit 1. What's the nature of the observations and what's the status of the facility now?
We are, as I said, so insofar as this facility is concerned, of course, it did go through a recent, the observations are, from our perspective, quite manageable. And we look forward to getting, this sorted out, and with our responses in the immediate future.
Okay, all right. So we'll leave it on that note. Good having you on the show today. Thank you very much for all the perspective and some sense on how the US business is shaping up. Thanks for joining in. Let's quickly move on and now put the spotlight on the consumer durables sector as the festive season is getting into full bloom. Aquarius, in a recent note, has said that industry dynamics remain extremely comforting. To talk about the key trends, we have with us Nilesh Gupta, MD Vijay Sales, and Anand Agarwal, CFO at V-Mart Retail. Gentlemen, thanks very much for joining in. Mr. Gupta, if I could start with you. So what's the sense you have this time around? What is the anticipation? Like to like festive season last year and compared to this year, what's the kind of growth you are anticipating?
So good morning, everybody. I think this year is going to be much better than last year. Although we had a good season last year also, but looking at the trends which we have seen on the 2nd of October, and yesterday was the first festival day, Navratra, and the way the consumers are coming in, I think we are in for a very good season. That's what.
Do you want to put some numbers to that, Mr. Gupta? How much better could this festive season be versus last year?
So I think we should be looking at a growth of anywhere between 7 to 10%. And mind you, possibly there is more chances of growth, but the issue is everybody maxes out during the season. So even if the consumer demand is more, nobody will be able to do more than 7 to 10% growth. And I think that's the max what can be done in a festive season.
Got that. And can you break that up category-wise? Say electronics, what's the expected growth there?
So basically, I think the driver of the Diwali would be definitely electronics would be more, but appliances also does well. So across the category, we find that we'll get a good growth across the category. But one thing which is going to be very good, which we were very skeptical, because last year, the second summer was very good. In fact, the main summer had just got totally lost out because of the incessant rain during the summer. And we had a good second summer, especially in the west part of the country and the south. And this year again, since last 1 week, we have been seeing rising temperatures. So AC growth is also expected. But across the category, I think we'll be seeing the growth.
Absolutely. Temperatures have flipped and how. Gentlemen, good morning, Mr. Gupta and Mr. Agarwal. Prashant here. Mr. Agarwal, if I can come to you, what are you seeing out there? What should we expect from your business and the categories that you're in for the festive period?
I think we remain quite buoyant and optimistic. I think we're definitely seeing better footfalls as compared to at least the last couple of years. This year has definitely been better. There is definitely better consumer sentiment that we are able to witness. Last quarter definitely had been quite good. And the start of this festive, as Mr. Gupta was also saying, I think has been quite promising. The monsoons this year have been very good. So thereby, at least the rural areas or the semi-urban areas where we tend to operate more are definitely looking more promising. We're quite hopeful to have at least, mid to high single-digit like-to-like sales growth. And that's what we have planned in terms of our inventory buildup and what our operations are going to, look like. But definitely, as of now, it's a bit early, but definitely looks very promising.
In Q2, the update that you provided, Mr. Agarwal, same-store sales growth was 15%. What can we expect for the October to December period? I mean, is there any indication at all?
So I think we will still want to look at least, mid to high single digit. Quarter two is a small quarter, and also we had a benefit of last year low base. But I think quarter three has always been a very, very good quarter, very big quarter. So improving on that on a high base in double digit will be challenging. So I would right now look at, first to get at mid to high single digit.
Okay. Mr. Agarwal, so that explains why I think sort of full year level you're still talking about high single digits and you're not talking about double digits just yet, right? So, okay, get it. So you're taking a slightly more conservative approach in terms of the guidance. But give us some more color on the revenue that you would hope to do on the back of this kind of same-store sales growth. And also, which are the markets where you're seeing sort of maximum growth at this point in time? Just some more geographical color as well.
Sure. So we're definitely slightly more overweight on East India and South India. We see that as a very big opportunity areas. East, particularly, we have not been very strong, but we have built up our portfolio this year in East. In fact, we have opened almost like 15, 17 stores so far in this year in East India alone. And we're quite bullish on South as well. South, as you know, we operate under the brand name of Unlimited. And we're looking at ramping up our presence in South significantly. And we're seeing good results coming in from both East as well as South. So that's two areas where we are definitely working on. In terms of how the overall sales should look like this year, I think we should definitely clock better than what we did last year in terms of the growth percentage. I think if we are able to look at high single-digit same-store sales growth and around 10 to 12% area addition, I think we should be conservatively be looking at around 15% plus at least for the full year.
Mr. Gupta, one final question then. Quick commerce has now expanded to electronics. We know a lot of Indians ordered iPhone 16 on many of the quick commerce sites like, Blinkit and I think Big Basket. How would you assess the threat of quick commerce for a company like yours and the industry?
I think when online came in, the same question was asked. Online has come in, so what's going to happen to the brick and mortar? So the same thing, my answer at that time also was the same, and today also I'll reply in the same way. The best part is in the country, the market is growing. So there's going to be a room for all the players. So there would be consumers who would want to buy instantly and they may go for quick commerce. There would be consumers who are okay to wait but want a deal and they may buy from wherever he gets a deal. And there would be a consumer who say, no, I want the traditional way. I want to go check out. Let us also understand that our product is not something which is discretionary. It's once in a year or once in 3-4 years purchase. People would want to touch and feel also. So I think there's a market for all, and like what online did for the industry, I think e-commerce will do the same. It will grow the market, expand the market. So I'm quite okay. Or rather, I would say I'm happy that more and more interest is coming in our industry.
Mr. Gupta, I can completely concur with you on that one. There are different types of customers and consumers. I'm clearly in the other category. I have trouble, guys, buying like curtains and stuff online. So forget buying high-value items like, phones worth lakhs of rupees. So absolutely, I think there's scope for all kinds of consumers out there. Thank you very much, gentlemen, for joining in. Really appreciate you being with us on the show today. Take a break right now. Come back on the other side. We'll put the focus on the commodity space with Manisha Gupta.
Welcome back. It's flat now. Nagraj Shetty of HDFC Securities is now with us on the show. Nagraj, what would be the index call and the 10 a.m. stock trades?
Hi, good morning, Reema. Nifty has been in a volatile session and we have seen some 1,000 points cut from the highs in the last 4 sessions. So if you look at the similar kind of a decline previously, we have seen similar kind of a knee-jerk actions from the higher levels, and eventually Nifty has bounced back from the lower levels. Market is currently finding a bottom reversal at the lower levels, and I believe that 25,000 to 25,100 is going to be the strong support for the market, which is the 23.6% Fibonacci retracement as well as the 50-week 10-week EMA. So I think I'm expecting market to bounce back, market to show some bottom reversal around 25,000 to 25,000 levels from the lower levels, and we could see some reversal and a bounce back. The quantum of bounce will determine whether we are going to see the new highs or we are going to see the lower top of the sequence. Right now, I'm a little cautious, and the market is finding some bottoms at the lower levels. And in terms of stocks, I have mixed stocks one from long side, one from short side. Long side, if you can discuss, the IT has been a phenomenal up move recently, and currently the Coforge is the one from the IT pack is showing upside breakout of the range movement. If you look at the chart of the Coforge, it was resilient during the volatile broader market, and it was actually outperforming the sector recently. I'm expecting currently trading around 7,200 levels. I'm expecting a decisive upside breakout in Coforge. One can look to buy at 71 currently trading around 7200 levels, and target would be around 7650, and one can place a stop loss at 6850. And one more stock is the Balkrishna Industries from Auto Ancillary. Balkrishna on chartically has damaged recently after the formation of a lower consistent lower tops. Recently, it is continuing with the lower top formation and decline. The overall chart pattern is looking negative, currently trading around 2930 levels. I'm expecting more declines in this stock. One can look to sell short in Balkrishna Industries, which is currently quoting around 2930 levels. And 2750 is going to be the next downside target for this stock price, and one can place a stop loss at 3050.
All right, Nagaraj, thank you very much for that. So those are some trades coming through. I just want to say that the markets picked up 150 points from the day's low, 50 minutes after market open. The big move is on the upside from the day's low. The day's low is 25,094, just under 25,100, and we are now at about 25,250. So that's been the story. And lots of stocks are moving, which we will get to in just a bit. But commodities is one area, right? I can see oil marketing companies selling off hard once again. HP is down about 3% on my screen, and a few others as well. But let's get the actual underlying commodities and what's happening there. Manisha is here with that. Manisha.
Well, thank you for that, Prashant. I want to take you through crude itself and various scenarios on how the street is working on whether the crude is going down or beyond 80 from here on. So what we are looking at right now is that we've seen 5% of gains in the crude oil prices in the overnight market. And with this now, we are heading to the best weekly gains since Jan 2023. If you look at on how the scenario really has been for the crude oil prices on a monthly basis, well, last month we saw prices decline by nearly 9%. And for the month of October, the prices have gained up by nearly 9%. Now, there have been various reports on whether or not the crude oil prices can go to 80 and beyond. That can happen if Israel attacks Iran's oil facilities. Well, that is something that has been discussed for quite some time now. Remember, Iran is an OPEC member. It produces 3.2 million barrels per day, which is 3% of the global output. Also, Middle East overall produces 1/3 of the global output. So if this spreads around in the Middle East, then we are looking at a concern. And yes, the crude prices can go up. The second scenario is that there could be a retaliation from Israel on the Kurg Island, which is Iran's main export facility. So we've talked about on production, and now it's about export. Iran actually exported almost 1.8 million barrels per day in the month of August. So that is something that can be immediately impacted. The third scenario is on whether or not the crude prices can go to 80 and beyond is if Iran disrupts oil flow out of Strait of Hormuz, and this would be most critical and crucial because this is where what would choke almost all the crude oil that comes in from Middle East. So these are the three scenarios that the street is working with. If any of this happens over the weekend going forward, then yes, you are looking at crude oil prices at 80 and beyond. Apart from that, when you look at the Russia-Ukraine conflict, when that happened, we did see the crude oil prices go to $130 a barrel. But then it did not sustain there, and we saw the prices come down quite sharply. The pricing closing for 2020 was 85. When you look at the last year, the range has been 73 to 93. Range until now this year has been 70 to 91. So we are far away from the highs of this year at this point in time, even as we're looking at various concerns there. Now, when you look at the global supply-demand mismatch, that is what is weighing onto the prices right now, is the reason you haven't seen 80 cross by right now. So OPEC and allies' spare capacity is quite high, much more than what Iran produces. Apart from that, the Libya oil production is coming into the markets. You also have weak Chinese demand. The US production has been on the higher side. So in sense of supplies, we are very comfortable and demand really not picking up. Now, going forward from here, it really is going to be about the US non-farm payroll data that comes in today. And then, of course, you have the US presidential elections coming in the month of November, and they wouldn't want the crude oil prices much higher. So it's going to be a very interesting next 1 month on what really crude does in light of all of that.
Thank you very much for that. With that, it's time for a short break. Don't go. On the other side, Lata will be in conversation with a host of experts to discuss if RBI follows the US and cuts rates on October 9th. Stay tuned.